Many young people ask me the actual secret to building massive lifelong wealth, and I tell them the absolute truth, but nobody wants to believe it. Everyone loves the comforting lie of a complicated trading strategy or a flashy cryptocurrency token while they're hard. Earned cash is silently being incinerated by inflation and hidden fees. We have been conditioned to believe that managing your personal capital requires some sort of supercomputer or a degree from an elite business school. The reality is that accumulating money boils down to basic third-grade arithmetic paired with high school psychological discipline. I spent the last 12 months tracking every single dollar that moved through my bank accounts and looking at the behavioral patterns of my friends. What I discovered is that most people my age are not actually broke because they do not earn enough money from their daily jobs. They are broke because they are trapped in a vicious cycle of spending real human hours on meaningless objects to impress people they do not even like. Let us sit down and have a raw, unvarnished conversation about what your consumer habits are actually costing you over a multi-decade horizon. Every single unnecessary subscription service or overpriced latte you buy is a tiny financial worker you just fired from your wealth machine. If you do not change how you view the correlation between time and capital right now, you are heading directly toward a very stagnant retirement. I am 25 years old and I refuse to follow the traditional broken script that the retail banking industry tries to push down our throats. They want you to look at credit card balances and financing options as normal lifestyle enhancements rather than chains around your neck. Let us break out a real spreadsheet and look at the brutal mathematical proof of how simple patience completely destroys frantic trading activity. Imagine you have two friends named Jack and Sarah who both start with a clean balance sheet of $10,000 at age 25. Jack thinks he is a financial genius because he spends 4 hours every single day reading stock charts and jumping in and out of hot options. He pays $15 in hidden platform transaction fees every week and panics the moment the broader market drops by 5%. Sarah realizes she does not know how to predict the future, so she chooses the most boring path humanly possible. She sets up an automated recurring deposit of $300 every single month directly into a zero-fee total market index fund. She never checks the daily price movements. She never watches the screaming talking heads on television, and she goes outside to live her life. Fast forward 30 years to when they are both 50 years old, and let us examine the catastrophic difference in their results. Jack spent over 3,000 hours of his limited life sweating over computer screens and ended up underperforming the baseline average by a wide margin. His account is sitting at a modest $56,000 because his emotional panic caused him to sell his positions at the absolute worst times. Meanwhile, Sarah entirely forgot her account password and let the automatic compounding machine run without a single human interruption. Her boring index fund delivered an average historical return of 9% per year over that 30-year window. Her initial $10,000 combined with her steady monthly deposits grew into a staggering $640,000 on paper. Sarah did not win because she possessed an extraordinary intellect or a secret piece of insider corporate information. She won because she understood that the stock market is a highly efficient mechanism for transferring wealth from the impatient to the patient. The financial media loves to make investing look like a high-speed action movie because that narrative generates clicks and trading volume for brokerage firms. They need you to feel anxious, so you keep clicking buttons and generating transactional revenue for the elite institutions in New York. But real wealth accumulation is an incredibly slow and boring process that closely resembles watching paint dry on a wall. Every time you look at a luxury item with a price tag of $500, you need to stop translating that value into raw currency. You need to translate that item into the exact number of hours you had to sit at your desk, dealing with your boss to earn it. If you make $25 an hour after taxes, that $500 gadget does not cost $500. It costs 20 full hours of your irreplaceable human life energy that you will absolutely never get back. When you view the world through that specific psychological lens, your desire for mindless consumerism completely evaporates. Every single dollar you save and deploy into a productive asset is a loyal employee that works for you 24 hours a day. That digital worker does not take vacations, it does not get sick, it does not complain, and it works perfectly while you are sound asleep. Why would you willingly execute that worker just to buy a pair of designer sneakers that will be sitting in a trash landfill in 24 months? The mainstream marketing complex is designed to keep you in a perpetual state of financial insecurity, so you keep consuming. They tell you that you need the newest smartphone or the flashiest vehicle lease to prove your worth to society. But true financial freedom is the absolute ability to wake up in the morning and do exactly what you want with your time. You cannot buy that level of personal autonomy at a luxury boutique mall, no matter how high your credit card limit goes. Let us examine the massive trap of investment management fees, because this is where the traditional industry robs you in broad daylight. An innocent-looking management fee of 1.5% sounds like a tiny, inconsequential price to pay for professional guidance. But when you compound that 1.5% fee over a 40-year working career, the math turns into an absolute horror story. That tiny fee will systematically consume over 1/3 of the total potential wealth your portfolio would have generated. You are taking 100% of the financial risk, you are providing 100% of the capital, and you are giving away 33% of your profit. And you are handing that wealth to a guy in a fancy suit who historically has an 85% chance of underperforming a basic index fund. It is an absolute psychological scam that relies entirely on your fear of looking at a simple math equation. We need to stop overcomplicating our asset allocation models and focus on the major foundational variables that actually move the needle. Your total wealth is determined by three simple factors, which are the amount of money you save, the duration of your compounding, and your psychological discipline. Notice that none of those three factors involve picking the perfect individual stock or guessing the exact direction of interest rates. The smartest economic minds on the planet have proven that macroeconomic forecasting is a completely futile exercise, yet everyday retail investors continue to lose their life savings trying to time the exact bottom of a market cycle. If a market downturn occurs, you should not view it as a terrifying tragedy that ruins your financial plan. You should view it as a massive retail clearance sale where the highest quality businesses in the world are being offered at a 30% discount. You do not run out of a department store screaming in terror when they announce a major holiday price reduction. So why do you log into your brokerage account and liquidate your equity positions the moment the red numbers appear on your dashboard? That behavioral paradox proves that investing is not an intellectual challenge, but an emotional battle with your own ego. If you cannot control your emotions during a temporary market correction, you have no business owning productive equities in the first place. You are better off leaving your currency in a standard savings account rather than systematically destroying your wealth through panic selling. The compounding curve is inherently backloaded, which means the vast majority of the gains arrive in the final years of the timeline. If you look at the legendary investment track record of Warren Buffett, over 95% of his net worth was generated after his 60th birthday. He did not discover a magical new stock market strategy when he became an old man. He simply let the exponential math of compound interest run its course over a 7-decade horizon without interrupting it unnecessarily. Most young people fail to build wealth because they interrupt the compounding process every 2 years to fund a lifestyle upgrade. They get a modest raise at their corporate job and immediately run out to lease a vehicle with higher monthly payments. They are running on a brutal hedonic treadmill where their expenses rise in perfect alignment with their income. They are working harder and harder every single year just to stay in the exact same state of financial vulnerability. If you want to break out of that trap, you must create an insurmountable gap between what you earn and what you consume. You need to live like a broke college student for a few years, even after your professional income begins to scale up. Take that excess delta and automatically route it into productive index funds before you ever have a chance to see it in your checking account. Out of sight, out of mind is the most powerful behavioral trick you can use to defeat your natural impulse to spend. Do not rely on your daily willpower to save money, because the entire world is engineered to separate you from your cash. The brightest software engineers in Silicon Valley are working day and night to make purchasing items as frictionless as possible. With a single facial scan on your mobile device, you can instantly spend a week worth of wages in under 2 seconds. The only way to win against that level of systemic temptation is to automate your defense mechanisms completely. Set up your financial infrastructure so that your future self is taken care of before your current self can ruin the plan. You do not need to read 50 financial textbooks or follow complex market commentary to understand this reality. You just need to accept the counter-intuitive truth that true wealth is simply the money that you choose not to spend. It is the invisible capital sitting quietly in your investment accounts that gives you options, security, and ultimate peace of mind. Stop letting the flashy illusions of the consumer market dictate how you evaluate your personal progress in life. Stay boring with your financial foundation. Stay patient with your compounding timeline piece.